Here's a number that should wake you up faster than your Monday coffee. 1.1384. That's where euro to US dollar is trading right now, and it's sitting less than 1 full pip above its most critical daily support level, 1.1383. Over the weekend, Bank of America sent out a note telling investors to stay long the dollar straight into Q3, and the market has already priced it in. But here's the trap. Most retail traders are looking at this chart and seeing a collapse. They want to chase the downside right here at the open. That's exactly why Monday's first hour is going to be a liquidity vacuum, and I'll show you how to exploit it. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. On screen text for the next 15 seconds, 1.1505, the line that defines your week, 2 Monday scalps plus 1 swing. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days, instant weekly verdict. The structural bias for the next 3 to 5 trading days is fade mode. The weekly trend is a strong sell, the daily trend is a strong sell, and the 4-hour chart is trying to stabilize into neutral, which means it's building the next leg of energy before the move resumes. The one invalidation level that flips this entire week from bearish to a neutral to bullish retracement is 1.1505. That's the weekly pivot point. Write this number down. 1.1505. If the daily candle closes above that level this week, the whole monthly structure resets. And we could be talking about a squeeze toward 1.1709. But right now, the herd is positioned short, and they're all sitting just below 1.1400, thinking they're early. That cluster of stops above Friday's high at 1.1420 is the exact fuel a liquidity run needs. That's the game on Monday. Let's go to the charts, from the weekly all the way down to the 60-minute, and I'll narrate the exact setup that shapes the next 5 days. On the weekly canvas, euro to US dollar printed another bearish engulfing candle, and it closed right on top of that 1.1383 structure. That level is actually the confluence of 2 things. It's the S1 monthly support and it's the 100-week moving average. The 100-week is coming in at 1.1368, so we are literally resting on top of it. The 200-week moving average is much lower at 1.1233, but that's not in play for this week unless we get a catastrophic unwind. The weekly MACD is accelerating below the zero line with both the signal line and the histogram sloping down. That tells you momentum is not just bearish, it's expanding. There's no divergence here. It's a clean trend continuation. The ADX on the weekly is 38 and rising, so the trend is strong. When you see an ADX above 35 on the weekly with the price closing below all the key moving averages, the 5, the 10, the 20, and the 50, that's a market that wants to seek lower value. The 20-week moving average is at 1.1604, and that is miles away from current price, acting as the ceiling of the bearish channel. So the weekly structure says, sell rallies until proven otherwise, drop to the daily time frame. Here's where the narrative sharpens for the next 3 to 5 days. The daily trend is a strong sell, with the RSI at 39, not yet oversold. That's dangerous because it means there's still room to fall before we get a mechanical bounce. The daily MACD is negative at -0.004, and the signal line is crossing lower again, suggesting we're about to see another thrust down. The MA20 on the daily is at 1.1503, that's almost identical to the weekly pivot, so 1.1500 becomes a magnetic resistance. The MA60 on the daily is 1.1556. And the MA200 is way down at 1.1233. What's interesting is that the price has just broken below the 100-day moving average at 1.1368, and it's now testing the patience of the market. If we accept below 1.1368 on a daily closing basis, it opens the door to the 200-day at 1.1233, but that's likely not this week's story. For the next 5 days, the real target is 1.1297, which is the S2 monthly support, and just above the 1.1270 zone that was a volume node in March. Here's what most traders will miss until Wednesday. On the 4-hour chart, the trend has flipped to neutral, and that's creating a hidden divergence on the MACD. The price made a lower low on Friday, but the MACD histogram made a higher low. That's a momentum slowdown. It doesn't mean we reverse. It means the next leg lower is going to need a catalyst, and that catalyst might arrive exactly on Wednesday. The 4-hour MA20 is sloping down at 1.1410, and that's the immediate resistance that must hold for the bearish structure to survive. The 1-hour chart is in a sell configuration, with the Williams %R at -88, deeply oversold, and the stochastic at 40 but pointing down. So Monday's open could see a tiny relief bounce that stalls right at the 1.1400 handle, where the 1-hour MA20 rests. That's exactly where scalp number 1 sets up. But before we get to the trades, I need you to understand that this week isn't just about technicals. It's about the narrative web. The fundamental driver this week is the Fed-ECB policy divide, and its widening. Bank of America's weekend note that investors should stay long the dollar into Q3 is not a casual comment. It reflects what the smart money is already doing. ETF flows into the dollar accelerated late last week, and institutional positioning on the euro is net short and growing. The story is simple. The Fed is on hold, possibly contemplating a hike in July if core PCE surprises this Friday, while the ECB is trapped in a stagnating economy with inflation undershooting. That spread is killing the euro. Now, this week's event calendar has one wildcard that the street is not fully pricing. On Wednesday, we get the ECB's long-awaited progress report on the digital euro. It's titled, "What Would the Digital Euro Look Like?" And while it's not a rate decision, it could inject a sharp intraday volatility spike if the language around implementation timelines or banking disintermediation spooks the market. That's the fuse. Outside of that, Thursday brings the final US Q1 GDP revision, and Friday is the core PCE deflator, the Fed's preferred inflation gauge. If that number prints hot, the dollar rips and we see 1.1297 in a single session. If it's soft, we might get the only bounce of the week, but it'll be sold. The 1 to 2 week directional lean is lower, with a target at 1.1177 on a PCE-fueled extension. The exact event that invalidates the bearish outlook is a daily close above 1.1505. That would signal the whole divergence narrative is being repriced. Do me a favor. Do you think the dollar closes above 105 on the DXY this Friday? Comment yes or no. I'm tracking consensus for the week. It ties directly to whether euro hits our swing target. Now, let's get into the execution phase. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching setup number 1. This is your Monday opening scalp. The focus is the first 3 hours of London session, because that's where the liquidity is thickest. We've got an intraday bearish structure, but the 1-hour Williams %R is oversold and price is sitting right on the Asian session low. If price retests 1.1400, that's the 1-hour MA20 and a Friday breakdown level, and shows a 5-minute bearish rejection wick, you enter short. Your trigger is a 5-minute candle that tags 1.1400 and then closes back below 1.1395, confirming the sell. Tight stop loss at 1.1415, just above the 4-hour MA20 and Friday's high. That's a 15 pip stop. Take profit 1 sits at 1.1370, which is just above the 100-week moving average, giving you a clean 1:2 risk reward. This is a fast snipe, not a hold. If the 5-minute candle closes above 1.1410, the setup is instantly void. You walk away. Let me put that on the screen now. The Monday opening SCLP entry, 1.1400, 5M bearish rejection close below 1.1395, stop loss, 1.1415 take profit 1.1370 risk, reward, 1:2.0 R invalidation, void if 5M candle closes above 1.1410 setup number 2, the Monday liquidity grab. This is a counter-noise scalp that exploits the fact that the herd has stopped resting just above Friday's high at 1.1420. Early in the session, especially if we get a spike driven by a European headline or a digital euro leak, expect a fake breakout above that level. The market will engineer a stop run, tap 1.1425 or 1.1430, and then reverse sharply. You wait for that trap. Entry triggers when price prints a 15-minute pin bar wick above 1.1420 and then closes back below 1.1415. That's the snapback confirmation. Place your short entry at the close of that pin bar, around 1.1415. Your stop goes just above the wick high at 1.1435, so a 20 pip stop. Target is the nearest liquidity pool, the Asian session low at 1.1380, which is a 35 pip gain, roughly 1 minute, and 1.75 seconds risk reward. This is aggressive execution. You need to be fast because the snapback happens in minutes. If price instead sustains above 1.1420 for more than 2 15-minute candles, the trap failed and you do not enter. Warning: this is not for passive traders. You're hunting a stop grab, and you must respect the stop. Here's the trade card. The Monday liquidity grab entry, 1.1415, 15M pin bar close below 1.1415 after a spike above 1.1420, stop loss, 1.1435 take profit 1.1380 risk, reward, 1:1.75 invalidation. Void if price sustains above 1.1420 for 2 15M candles, you scalping Monday or swinging the week. Comment scalp or swing. Let's see who's built for this market. Now, the real money this week is in the swing, strategy 3, the 3 to 5 day swing. This is the trend alignment trade, designed to capture the core move from midweek until Friday's close. The bias is firmly short, aligned with the weekly and daily strong sell. But you don't just jump in at the open. You wait for a daily close that confirms the breakdown. The trigger condition is a daily candle close below 1.1383, which is the S1 support we are testing right now. If we get that close, it confirms that the 100-week moving average at 1.1368 is failing, and the momentum is ready to accelerate. You enter short on the next day's European Open, let's say Wednesday, if the Tuesday daily close was below 1.1383. Your stop loss goes above the weekly structural level at 1.1505. That's a 122 pip stop, so size accordingly. The logic: a daily close back above the weekly pivot would indicate a false breakdown and a trend failure, so that's your hard invalidation. Take profit 1. Is the S2 monthly support at 1.1297, which is 86 pips from a 1.1383 entry, giving a 1 minute and 0.7 seconds risk reward on the first target, but this is a multi-target swing. Once price reaches halfway to TP1, around 1.1340, you move your stop to break even. Take profit 2 is the S3 support at 1.1177, a stretch target that could hit on a hot PCE Friday. If we take that, the total reward is 206 pips, turning the risk reward to roughly 1 minute and 1.7 seconds. That's the institutional way. Let the week work for you. The trade is voided if the daily close is ever above 1.1505. On-screen plan now to 3 to 5 days to NG entry, 1.1383, next European Open after daily close below 1.1383, stop loss, 1.1505 take profit 1.1297 take profit 2, 1.1177 risk, reward, 1:1.7 to TP2, invalidation. Void if daily close above 1.1505 risk management pulse. Never risk more than 1 to 2% per trade. Holding through high-impact event days like Wednesday's digital euro report or Friday's PCE requires tighter sizing. Stops are non-negotiable, especially on the swing. That 122 pip stop on the swing is wide because we are respecting the weekly structure. If you can't size it to fit your 1% rule, you don't take the trade. This is how you survive to trade the next big weekly move. Here's the one level that rules everything this week, 1.1505. If the daily candle closes above it, the bearish structure is broken, and the monthly trend has to be reassessed. The week's finale could be wild. Friday's core PCE is the volatility climax. And if it prints hot, we'll see a freefall toward 1.1177 that will leave latecomers chasing. If this level breaks on Friday in the opposite direction, the whole monthly trend flips, and I'll have the updated blueprint for you this Sunday. So lock in the follow-through. If you want last week's recap to see how we got here, how we nailed the 1.1500 rejection, that video is live now. Tap the end screen. Then hit the bell so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week.